Everybody, this is Bennett Tchaikovsky, the accounting professor. Again, welcoming you to another lesson here on financial statement analysis. And today we're going to be looking at leverage and coverage ratios. So my disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my employers or any other affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Presentation is copyright 2008 to 2025 by Bennett Tchaikovsky, all rights are reserved. Any distribution is strictly prohibited. So today we're going to be looking at our leverage and coverage ratios. And what we're really kind of looking at here is that this really kind of has to do with debt. And if we're taking on debt, how does that kind of look? And one of the things we want to kind of remind ourselves of is that what's the advantage of essentially going into debt? Well, I don't dilute my ownership interest, right? I'm not going to dilute my ownership interest. I'm still maintaining my ownership interest. However, I do have to pay it back eventually. And I also have to pay back the interest, but that interest is actually deductible. To a certain extent, I'll let the tax people go through and figure that one out. I can deduct my interest, but again, a lot of those people choose to use debt financing. Amazon, when Amazon first started, way back when in a galaxy, a long time ago, far, far away, they were essentially going through and funding their operations with debt. So again, it's really up to the individual company in terms of how they're going to go through and decide to, how they're going to go through and do it. So let's go ahead and take a look at some of these different ratios. One of the most important ones is going to be times interest earned. And what exactly is times interest earned? Well, times interest earned is really going through and showing our ability of how much is also known as the interest coverage ratio, is what type of ability do we have to go through and to cover our interest payments. And if I go ahead and look at our income statement, and well, what's interesting here for Five Below is that they appear to not have any interest expense. So let's go ahead and take a look at this real quick, make sure that we're on the right track. Okay, they don't really have any interest expense, but let's kind of go through and take a look at a company that does. And that company would be Amazon. Or excuse me, that company would be the Home Depot. So if I go ahead and look up our friends at the Home Depot, what you're going to go ahead and notice is that if I was to do the interest coverage ratio for the Home Depot, and I go ahead and pull up basically their financials. When we look at the interest coverage ratio, and let's go ahead and go over here. So times interest earned, this is going to be interest before income and taxes. Well, for Five Below, this is basically going to be no debt. And so I made my life a little bit easier on this front. So over here, there's no debt, so we don't have any kind of debt service questions. However, if I was going through and doing this for the Home Depot, what would this look like? Well, I would need to basically figure out what is my income before interest and taxes. So a way we could be looking at this here is by taking operating income. we'll just go ahead and say this is 21,526,000,000. If I took 21,526,000,000 and I divide this by my interest expense, and this is 2321. And if I did this for the prior year of the Home Depot, my operating income is, or my earnings before interest and taxes is 21,689,000,000. And here my interest expense was 1943. My times interest earned, and this is for the Home Depot, is 9.2, and it was 11.1. The higher this number is, the better it means the ability I have to go through and to go ahead and basically pay off debt. How much coverage do I have of my earnings basically to go through and service my debt payments? Okay. Now, if I were to also go through and do this over here for my debt service, so that would be times interest earned. So for the companies I selected, it's not applicable. But if you have a company that has debt, you would need to go through and to absolutely basically make sure that in going through and doing this, that when we look at you would have operating income, which is the same thing as the earnings before interest and taxes. You divide this by the interest expense, and that gives you your interest coverage ratio. So the next one over here is I would have to figure out, well, for the Home Depot or my debt service, can't get there, my debt. Let's see here. Debt. See if we can find something over here. Return on invested capital. Okay, debt payments. Let's try debt payments. Oh, no, I found the one. Let's just keep on looking at the debt. Okay, so if we go here at the beginning, debt and derivative instruments. So if we're going, and here's what so if we look at times interest earned, this is a relatively, clean, but basically this is a relatively clean ratio, right? So this is essentially going through and taking earnings before interest and taxes, dividing by interest expense. But the one kind of limitation on this is that times interest earned does not consider principal repayments or other fixed financial obligations, which could overstate a company's actual ability to manage debt. Also, earnings before interest and taxes include stock-based compensation, depreciation, which may have no impact on cash flow. And again, the industry variations, what's acceptable in one industry may not be acceptable in another industry. But that's how times interest earned works. If you are taking one of my classes and you have a company that has debt, you need to be looking this up. Now, when we look at the debt service coverage ratio, this is going to be something over here where we're looking at the numerator of earnings before interest and taxes is going to be the same as times interest earned. But what we're looking at here is something like, well, we're not only looking at the interest payments, but we're also going through and looking at the debt payments. Now, for my company that I chose, it's irrelevant. However, when we go through and oh boy, we can actually see the principal amount, the carrying amount. Here's all the long-term debt. And we got the interest payable. And this kind of looks like, let's see here, long-term debt. And I guess these are just senior notes. We're not making any kind of principal repayments. Okay, so right over here, current installments of long-term debt. Okay, so if we were to go through and look at the debt service coverage ratio, right? So if we took over here, oh, we're going to be able to hopefully find this. So the current installments of long-term debt are going to be 4.5 billion, right? So we really would say in terms of my debt service coverage ratio, basically my debt service, which we're going through here and defining the principal plus the interest payments. So if I was to look at this for the Home Depot, my basically will call these two amounts, we'll call this 4.8 billion. So if I took 2321 and I added in my debt service coverage ratio is now at 3. Now again, just pull these out of, you know what? 5 below doesn't have any debt. But if you are going through and if you're taking my class, you want to go through and find the long-term, any kind of short-term debt, mandatory repayments, and you want to be going through and adding these up together in terms of what is obligated, the current installments of that long-term debt. Okay, so let's go ahead and now take a look at some other ratios that hopefully we can go through and compute. So over here, my next ratio going over here is a debt service. Why is debt service, again, a little bit better than times interest earned? Because it's not only including the interest expense, but it's also going through and including the principal payments. Okay, so let's take a look at the debt to equity ratio. What is the debt to equity ratio? It is my liabilities, total liabilities divided by total equity. So this is a ratio, financial leverage ratio that measures a portion of a company's financing coming from debt versus equity. It shows how much the company uses to fund its operations relative to the amount of equity provided by shareholders. So it's going to help us assess that financial leverage as well as evaluating financial risk. And then it's kind of helping us determine the balance between debt and equity. So let's go ahead and take a look at this for 5 below. So for 5 below, I'm going to go ahead and pull up, kind of do this over here. We're going to pull up to the balance sheet right over here. And I'm just going to go ahead and use the year-end numbers. So my debt to equity over here, my total liabilities for 5 below are 2.5 billion. My total equity for 5 below is 1.8 billion. For my prior period, or for 2/3/24, my total liabilities were 2.2 billion, and my total equity the year before was 1.54 billion. So my debt to equity ratio is going to be at 1.39. And over here, this is going to be at 1.44. Now, so again, this is for 5 below. If you're doing Dollar Tree or Dollar General, every company, again, is going to be different. So, but let's kind of take a look at this. Let's go back over here to the Home Depot and let's just kind of see what's happening at the depot. And for this one, I'm going to go ahead and just jump to a more recent quarterly report. And I've got 89 billion or 89,384. And then I have equity for the depot of 89,384 as of August 3rd, 2025. And I have equity of 10,665 million. So my debt to equity here is at 8.38. So I would probably say for the Home Depot as well, wow, that's a big number. They're highly leveraged, right? Now, here's the thing that you have to realize when you look at companies. Why is that number so ridiculously high, right? Well, if you look at the owner's equity section of the Home Depot, you're going to notice treasury stock. What's that? It's when I repurchase my own shares. When I repurchase my own shares of treasury stock, like in this example here, it's going to show up as a negative number in the owner's equity section. Now, if I normalize this, meaning if I added back 95 billion to cash and then I added back, 95 billion down here, I could try to normalize it and my debt to equity might look a little bit normal. In fact, it would look less than 5 below because my equity would be greater. However, it's a decision I made to go through and to repurchase those shares. So that's why that ratio is so high for the Home Depot. Again, how does this compare? You have to look at the other companies that you're kind of going through and doing it. But obviously, the lower number, the better. It means that we are less leveraged and we haven't borrowed as much. So let's go ahead and now go to, that was the debt to equity ratio. Let's go ahead and do the debt to assets. So this is also a financial leverage ratio that measures the portion of a company's total assets that are financed through debt. And so again, this is really kind of this actually should be total assets, debt to assets. Sorry about this. So there we go. Okay, so my total liabilities, not changing here for 5 below. My total assets over here are going to be 4.339 or 4.3 billion. And over here, it's going to be 3.8 billion. So my debt to assets are going to be 0.58. And this over here will be at 0.59. And now you might be asking yourself, well, hey, Bennett, that's great, but can you ever have something? And if we look at this for the Home Depot, well, it's going to be almost at 0.9, right? Or 89 billion divided by 100 billion. And you might be saying to yourself, well, Bennett, could we have a situation, not like a Jersey Shore situation, my dad humor for the evening, but Bennett, could we have a situation where you would have like a negative debt to equity or a negative debt to total asset or a number higher than 1 for debt to total assets? And the answer is sure. If we go ahead and look at Lowe's, right? Lowe's has assets of $46 billion. They have liabilities of 58 billion. So if I looked at this, total liabilities, and then total assets of 46,614, you get a debt to assets ratio of 1.24. Is that a problem? Well, I don't know. They've got negative equity, right? Why do they have negative equity? They've got an accumulated deficit. They've also gone through and have retired a bunch of their shares through treasury stock. And when you look at this here, this is a company, or Lowe's is a company that is highly leveraged, right? This is a company that is highly leveraged, long-term debt. There you go. So this is a big thing. So again, something for you to kind of go through and think about as you're looking at these different companies. So for the debt to capital ratio, good again. So this is also going to be making my life way too easy. These are both going to be non-applicable. But if I were to go through and to do this for Lowe's, and let's go ahead and take, so that was the debt to assets, the debt to capital. Did I call that the right thing? Debt to capital ratio. So the total debt includes all interest-bearing liabilities, such as short-term debt, long-term debt, and other borrowings, and then equity is all equity. So if I were to do this, say, over here for Lowe's, what would that look like? Well, I would say the current maturities of long-term debt are going to be 41.75. And over here, my other interest-bearing items, long-term debt is 30,548. So my total debt is going to be 34,723. And when I look at my equity, well, my equity is actually a negative amount. So my equity here is going to be negative 11,400,000,000. So here, my debt to capital ratio is 1.48. That's not good. Even for the Home Depot, if I were to look at this, it's not near, it's still going to be under one. So again, this is something we're going to be going through and looking at as we're looking at these different companies. Let's go ahead and take a look at now the cash to debt ratio. Again, not applicable because this is going to be no debt. But going on our fun with Lowe's, I don't mean to say that in a negative way. Maybe I do. 4175. And then the other debt that Lowe's had was 3548. So Lowe's has total debt of 34,723,000,000. And if we look at the cash and cash equivalents, it's 4860. So the debt ratio, cash to debt ratio for Lowe's is not good. Let's take a look at what does this look like for basically for Lowe's. And by the way, what exactly are cash equivalents? Well, I should have been a little bit more fair. I should have added 396 on the short-term investment. So let's go ahead and 4860 plus 396, slightly better. If I did this though for the Home Depot, and I said here, like, okay, they're cash and cash equivalents, right? The most liquid assets. So this is going to be 2804. And I'm dividing this by my total debt. My total debt over here is going to be my current maturities of current installments of long-term debt of 6.4 billion. And then I've got long-term debt here of 45,917. So this is going to be 45,917. And then I'm going to have 6.4 billion. So surprisingly, while my cash to total debt actually for the Home Depot is actually less than Lowe's. And I would probably want this number to be higher, right? Why would I want this? Basically, I would want this to basically higher, again, for this cash to debt ratio is a financial metric that measures a company's ability to cover its total debt obligations. Yeah, this is not good, right? I would want that number to be as high as possible, meaning that I can actually cover my debt. But again, have to kind of look at things and every company is going to be a little bit different. Okay. So now we're going to get into our next example here, and I'm going to go ahead and go back to Five Below because I'm going to have to go through and look at some cash flow things. So our next item up for bids on the Price is Right. It's right over here, and this is going to be my free cash flow, and the free cash flow is described as cash flow from operations minus dividends, minus capital expenditures. So it's a measure of a cash the company generates after accounting for capital expenditures, other long-term investments, the cash available for the company to pay dividends, repay debt, or reinvest in the business. Essentially shows how much cash the company has left over after maintaining and expanding its asset base. Now, for us, for our all intents and purposes here, we don't have to worry about dividends. Right, so this is basically right over here, and I left out dividends. So let me make sure that that gets added in. Yeah, okay. So cash flows from operating activities, capital expenditures minus dividends. Okay, so, and you might be wondering, well, what is this about cash flows from operating activities? Well, if we look at this from the perspective of on our statement of cash flows, what this is hopefully here is to help us go through and do is to tell us, well, how much cash are we actually generating by, essentially by through our operations. So we're adding back depreciation and amortization because that's going to be a non-cash charge. So let's go ahead and basically figure this out for Five Below. So we've got 430, 648. So over here, my cash flows from operations is 430, 648. My cash flows from operations, I'm just going to get rid of this stuff over here because it is not applicable to companies. So here I've got cash flows from operations, and this amount here is going to be 499, 619, right? The dividends is not applicable. Okay, and I'm going to say less capex, and my capex over here is going to be capital expenditures, 323, 994. And then here, this is going to be 335.50. So my free cash flow is going to be 106 million. And then over here, it's going to be 164 million. Okay, so that's going to be my value here. And my value over here is going to be this one. And I'm just going to go ahead and highlight this up a little bit just to make sure that we're on the right track. So I'm pulling the right number when I go through and do this part. Okay. So that's going to be our free cash flow. So, how much are we going through and really going through and generating? Okay, the equity ratio. Okay, so the equity ratio is a financial ratio that goes through and measures the proportion of a company's total assets that are financed by shareholders' equity. It basically provides, basically provides insight of the company's financial structure. And so again, it's like how much of the assets are owned by the equity and not essentially by debt. It's kind of an inverse debt to assets ratio. So let's go ahead and take a look then at the equity ratio. So our equity ratio here, our total equity for Five Below is going to be 1.8 billion. I'm just pulling this up here from my prior ratios I went through and did. And this part over here, my total assets are going to be 4.3 billion and then 3.8 billion. So this over here is giving me roughly 0.42. And then over here, I've got 0.41. Now, what's interesting as well, if I add up, because the equity plus assets equals liabilities plus owner's equity. So these numbers should be equaling up to 1 unless you're Lowe's. So because their assets are less. So I shouldn't be making fun of Lowe's. Okay. So, but that is the equity ratio. Okay. So again, and then over here, this is an interesting one. And this is going to be something we're going to be looking at when we take a look at the DuPont formula a little bit later. But the equity multiplier is a financial leverage ratio. It's also known as financial leverage that measures the proportion of a company's total assets that are financed by shareholders' equity. It reflects the degree which a company uses debt to finance its assets, and it's a key component of the DuPont analysis. And so over here, we're just basically flipping these amounts right over here. And so we're going to get 2.39 2.4, and then we're going to go ahead and get 2.44. And how does this compare? Well, we would have to pull up a company that's similar to Five Below and kind of take a look at it from there. So as we go through and now kind of say to ourselves, well, let's go ahead and go to our summary. Okay, so for our summary, well, I made my life way too easy, but I did try to show you some Lowe's and Home Depot action, which hopefully was exciting for you. So these are all going to be not applicable because there is no debt. My debt to equity ratio was 1.4, and this over here was 1.44. My debt to assets ratio was 0.58, and then over here was 0.59. Again, my debt to capital ratio, my cash to debt ratio, these are all going to be non-applicable because there is no debt. My free cash flow over here is 106,704. And then here it's 164,569. My equity ratio here is 0.42. My was 0.41 in the prior year. My equity multiplier is 2.4. And then here my equity multiplier is 2.4. So those are some examples over here of some leverage and coverage ratios. Now, when you go through and look at this, if I just do a simple Google search, I might find other ones that maybe like come up. I think I got most of these, but I didn't get like, I'm not sure if I got the net EBITDA fixed charge coverage ratio. So as you can see, the more you go down the rabbit hole, the more kind of stuff you're going to go through and find. But again, when you're going through and choosing these different ones is like, if we look at this, the Corporate Financial Institute, again, this is stuff that's owned by them. I'm really kind of like looking at this from like what are leverage ratios. And again, basically looking at all these different ones here. So this is obviously due. The one cool thing about financial statement analysis is really between, Wikipedia, or I should say Investopedia, and a lot of other websites. You can really do a lot of the stuff on your own. My true thing I would share with all of you is, as you're looking at this, is make sure, and I'm probably going to pull up my AI app at some point on a later video and have it kind of like see what it comes back with in terms of the analysis. But that's something I want to kind of go through and take a look at. But at least when I'm going through and doing, the financial statement ratios, hopefully you're finding this helpful. So in any event, thank you for being with me here today. Thank you for watching. Please don't forget to like and subscribe. If you've got questions, feel free to email me at 1812cpa@gmail.com. If you're looking for any other video content, feel free to ask. I will try to oblige. Have a great rest of your day, and I look forward to seeing you on the next video. Have a good day.